Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you for joining us here as we turn to June and the first Market Carver of this great month. So we've got a few topics to talk to you about. In the spirit of the Indy 500, coming off Memorial Day weekend, got a couple of car points for you. One on the future, really, of car and car sales. And then we'll take a look at the average age of cars and what that might mean. Debt ceiling is a topic. Hopefully we're close to moving into the rear view mirror, staying with the car analogy here. And then we'll move from that and look at agriculture, which is I'm really interested to hear. Saw this headline and just got a little preview from Andrew, but just anecdotally looking out at the fields here and really not seeing something conducive for at least the soybeans that are planted in the several hundred acres around me. So be interested to see what you say around for the rest of the country. We'll start right now with the cars and looking at this piece going forward. So this is from a few weeks ago out of Barron's, which really had a really interesting look at auto manufacturers and how they're trying to transform the business. And while this is a series of items on a bar chart, there's really a lot that they're trying to accomplish here. So you can see where car sales were in 2021, and that black box represents your traditional auto revenues. Ford, GM, which employed many of you watching, I know this to be very true. This is traditional auto sales. And you can see the growth that we should continue to sell more cars and at higher prices, contributing to rising auto revenues through the decades as we go forward. But right now, the plans out of the big three and even beyond that is to expand from the traditional sources of revenue and really trap into the data-rich centers that they are. Much like many other industries, when you produce a lot of data, you want to turn to ways to monetize that. And that has several implications. Number one, it's creating new revenue streams. But number two, it could actually mean a lot more for their stock price. A lot of them remain to be seen on that, but General Motors and Ford, these are stocks that really haven't done anything for a very long time. And for various reasons, they've struggled with operations. They've had a lot of competition, particularly from Tesla. And we've seen them stuck as really value stocks in a whole camp full of valuations that haven't gone anywhere. So part of what they're doing here is trying to transform into something that has a different price to earnings multiple. And that digitally enabled revenue certainly could be that. One of the most interesting to me anyways is really they're getting their foothold into the insurance industry. Few people would have better data in terms of potential auto data and useful to underwriting insurance policies than the cars themselves. And so they're really trying to make good money off of that. And that should, if they would have a price to earnings multiple that looked like insurance companies, they would be a lot better off. So that's what they're trying to do and something that interests us and we'll be watching going forward as an asset management team. Can't say that General Motors or Ford are right now on the immediate buy list, but over time, if they're able to actually execute this, would be very interesting. And the other thing that I'll give you is the average age of car. Something that we keep fresh on mind through time is just how we're able to have older and older cars on the road. And it's basically a straight vertical line at this point in time. Part of this is quality, right? The better cars that we have able to go longer mileage, the older that they become. Part of it is just simply we are stretching more out of them. And what this means is that it's good for auto parts and even salvaged auto parts. And so there's really, we have to pay attention to that as well, because this has been one of the things that hurdles the GM and the Ford to begin with. So needless to say, we are pushing close to 14 years for the average car on the road. Trucks, of course, not quite as old. And so that is something that we keep in mind with various positions that we have in the portfolio. So that's what I have for you in terms of cars. Andrew will now pivot and talk to you about the post-debt ceiling world and what we're looking at as we head into the first week of summer.
Man, I hope we're post-debt ceiling by the time this video comes out on Thursday. So over the weekend, we did get the encouraging news that a deal had been reached. Now they plan on having the votes within the Senate and the House this week. hopefully by Thursday, they say that everything should be wrapped up and we'll be able to move on to new and better topics. And with that, we are going to assume that hopefully a deal gets passed and looking at post-debt ceiling implications for the market. Again, what we try to focus on is really what is going on in the world and how does it impact our financial markets. And one of the biggest implications as far as the debt ceiling had was the Treasury began having to pull down their general account. And this is something I think we've talked about several times with our debt ceiling discussions in the market, Carver, when we do bring it up, is that the Treasury has their general account. Think of it as kind of the government's checkbook in the simplest of terms, and they've brought that down to very low levels. You can see on the far end of that chart, that black line came all the way down to levels, very, very low levels coming into 2022 and then going back. We saw the general account explode higher coming out of that COVID crash as we started seeing a lot more stimulus, a lot more money getting it was coming in for the government, and they had kind of the Fed had put a bunch of more money in the general account that then got dispersed among tax recipients from the stimulus. And so now that's all come back down. And what we found is there's actually a negative relationship with the Treasury general account because there's only so much money that can go so many places. When the Treasury is issuing bonds, those bonds have to be bought by someone, and it's often banks. And so banks use their cash to buy these bonds, and that pulls some of the liquidity out. And so that's what the Treasury will likely begin to do is they will try to reload their checking account, so to speak, after that we've now had this debt resolution, and they try to bring those levels back up. Many analysts expect the $600 to $700 billion range, and they'll do that through T-bill issuance and different types of shorter-term bonds to kind of rebuild those coffers. The implications this has for the equity market is this could pull some liquidity out of the fixed income space, and that can have implications for the equity market as well. We've seen prior times when the Treasury has kind of reloaded this general account that the equity market has had some stumbling blocks, some tougher period, a little bit increase in volatility. Now, the one caveat to all this is it's very well known. This isn't a secret to the market. The fixed income markets are aware it's going to happen. And so it may be something that we call priced in, that the market already kind of knows it's going to happen and we don't see a huge market response to it. But it is something that as asset managers, as people that are fixated on the fixed income market, we want to be aware of it. We want to know who the key players are in each market and how they're acting. And coming into the summer, we will see the Treasury and the Fed begin to become more active as they try to rebuild that checking account coming out of the debt ceiling discussions. And hopefully we're moving on beyond that. Now, to a topic that's probably a lot more interesting to a lot of viewers, I know more interesting for Adam, as he's my resident go-to farmer with literal boots on the ground for farming. The closest I get is a Kroger. But needless to say, I still am very much watching the agricultural markets, watching the individual crops. And we like to see how the different trader groups are positioned within the futures market. And so we can do this for corn, oil. We talk a lot about oil, gold, and soybeans. And so when we see the traders are active in soybean futures, they get divided up in different trader groups. We have small traders. It was if I went and bought a futures contract in soybeans, I'd probably be considered a small trader. We have large institution traders, and then we have commercial traders. Now, to be a commercial trader, you have to be involved within that underlying commodity within your business. So think farmers, food production companies, anyone who's using soybeans within their business would be considered a commercial trader. And traditionally, this group is often short soybeans, as they are many of the commodities, as they're using this as a way to hedge their exposure they may have to soybean prices within their business. And so what we pay attention to is when this group that traditionally is short a commodity begins to get long that commodity. And that's what we're starting to get really close to in soybeans. Now, I know there's a lot of lines on this chart, but it's very easy to break down. When we see those red lines, those vertical red lines, it's telling us when commercial traders go long soybeans. So again, traditionally they're net short, they're hedging their exposure. And when they go long, that's a very bullish. They're taking on additional risk to soybean prices by becoming net long in their financial accounts. And we can see traditionally that has been positive for soybean prices, because the one instance that broke away from this was 2014. But going back to the mid 2000s, when this has happened, we have often seen a rally in soybean prices. And soybean prices have been coming down significantly throughout 2022, as you can see on the far right side of that chart, coming down from about 1,700. Now we're around closer to 1,300. And this is where we're starting to see kind of those smart traders, the people that are really involved in soybeans, are saying, hey, maybe this is a place where soybean prices could start to firm up, and they're pulling back that short exposure, all those hedges, to be more neutral and possibly get net long. And so it's something we want to watch. Maybe we start seeing some rise in prices on the commodity side, at least in soybeans. But this chart caught my attention over the weekend, and we know a lot of you are very involved with the agricultural market, so I thought it was very important and interesting to share.
Yes, thank you, Andrew. And it's kind of interesting to me. Just I have one high school golfer, one middle school golfer. So this past 2 months have been very busy after work, watching those kids do that. It's been very busy because we've got debt ceiling, we've had all sorts of things in the business, and so now just kind of having an extra day or two on Memorial Day finally to look around and say, hey, boy, we really need some rain. And if the rest of the Midwest looks like us, we need a lot of it, and we need it pretty quick. So this is very timely chart. Appreciate you sharing it, and thank you all. Sure. I know I'm preaching to the choir to many of you, so I do appreciate you giving us your time as always. And don't forget to give us a call, 800-928-4001. And hopefully you can join us some point in time for a complimentary Next Steps meeting if we don't already have the chance to work with you. So thanks again, and have a great weekend.